Okay, started recording. All right, so today um, we're focusing on futures and the topic from losses to break even to consistent profit swing trading futures. So this is basically myself and Becky, who's a co-host. She's my trading partner. How we started trading in 2005, and I actually left my full-time job in 2009 to just be able to trade to generate primary profits, and then I can do all the other stuff I really wanted to do. They kept telling me, I kept telling them at work the stuff I wanted to do with acting, movies, stunts, other things in the world I wanted to do. And they kept telling me, well, when I retire in 25 or 30 years, I'll have time to do all that stuff. And I was like, oh, heck no. So I was looking for a way to be able to walk away from my engineering job and still being able to support myself, have a place to live and food and everything else. And we found trading. Trading was that path to let me walk away from my full-time engineering job and still be able to pay my bills. So that's been the foundation for me for quite a while now. And as we went along, as time has gone along, we've gone from losses to break even to consistent profits. We tried different things, but futures have really been a consistent thing for us with profitability and consistency. We got away from futures briefly only because margin had gotten too high and we couldn't do what we were doing because the margin was just ridiculously high. As an example, when we were swing trading NASDAQ futures, the margin was $2,000 per contract. Now it's 22, it's over $20,000 per contract just to open one contract. And because of so it's just you needed an account so much bigger as margin got bigger. So we got away from futures and went to Forex for a while where we could trade smaller size, but then came the micro futures came back to life and came to life in 2019. So we shifted away from Forex and back to futures. And now we could trade the micro futures, trade any size account we want. And it also makes it tradable for the people I'm coaching. The reality is that you can have an account as small as $1,000, $2,000, or an account as big as $1 million or more and do the exact same trades. Just put it in the chat window, link to the handouts. So if you want to get a copy of those, you can go right there and download it. So scroll down here. Disclaimer, everything we're doing today is basically for educational purposes only. What I'll be talking about is showing you how myself and Becky examples of how we make money from the markets consistently and what to expect and what we see, what we've gone through, and what you should expect to go through when you are trading these strategies or any other type of plan that you're trying to implement. It's a reality check and you have to know what to expect because when it's happening to you, you tend to freak out. It's like, wait a second, this isn't working, I'm stopped. But you have to understand the big picture, and that's the business-like approach that we're going to be going through. All right, so the only futures contracts we currently trade are these here. Australian dollar, British pound, Canadian dollar, euro, S&P futures, ES, NQ, Russell, Swiss franc, and Dow. The reason we trade these are because, number one, they have micros available to trade. Otherwise, as an example, NASDAQ futures about 20 something $1,000 for one E-mini margin. It's 10 times less. It's $2,000 for one micro. Australian dollar is 2,000 something dollars margin for one contract. It's about $200 margin for one micro. So you can trade a lot smaller accounts and control your risk a lot easier. Futures are pretty exact. So I know I can literally put together a plan to determine how much I'm going to make or lose each year, like any regular business. I can have an actual plan. If I have this much money, I take this many trades. Here's my expected profits. Here's my expected losses. So before we even get going, I'm going to summarize everything we do with a couple of quick calculations. So I need someone with a calculator out there because we're going to do some simple math. And I'm going to sum up what we do really fast with some simple math. and then we'll go through it in more detail. So someone pull out a calculator. All right, here's a number. We place, let's say we place 20 trades, 85% winning trades. We're placing 20 trades, 85% wins. On average, at the low end, on average, on a winning trade, we make $400. We risk $1,000 risk on every trade. So 20 trades, on each trade, we can lose approximately $1,000. But on 85% of them, we're going to make 400 on average. Some will be less, some will be more. On average, 400. That's 17 wins and 3 losses. Okay. If I have 17 winning trades at $400 each, how much profit is that? What's 17 times 400? 17 times 400, with that number, please type it into the chat window. 17 times 400, what's that number? Someone type it in. I got two more numbers to calculate. 17 times 400, what's that number? Someone please type it in. 6,800. Okay. 17 times 400, $6,800 in profit. If I have 3 losses, 20 trades, 85% winning trades, you're risking $1,000. That's 3 times $1,000. It's a $3,000 loss. 6,800 minus 3,000 equals 3,800. That's our net profit. That's how we trade. This is how we trade. If it goes to 87, 90% wins, this is making 2 point something dollars for every $1 lost. And if we go to 88 to 90% wins, then you're making $3 for every $1 lost. Okay. So this is literally how we trade and make money. It's by trading repeatable strategies, pure technical. There is some fundamental built in as far as when to not trade, but this is our expected profit and loss for the year. If we follow, this is with a 4% account risk per trade. This is risking 4% of account per trade. Okay. If you only risk 2% per trade, then you cut these numbers in half. Okay. You don't want to go more than 2 to 4% account risk per trade, because although it might sound, well, I have all these, I can do, people forget about margin. Margin can tie up big chunks of your account. I got people who trade with anywhere from a $3,000 account up to a $500,000 account. Got someone recently who was trading, a mid-size account, about $100,000, and they didn't think about margin, so they're risking approximately $5,000 per trade. Okay, it's fine, whatever. It's a little bit high, but $5,000 a trade. And they didn't think about how much money that actually ties up. You place one trade on the currencies because of the number of contracts you have to get. Although your risk is 5,000, it's actually tying up between $15,000 and $20,000 in your account, and margin is actually tied up. The margin is not at risk, but it's being used. You have to put something up, and you put up margin. The margin's not at risk, but you got to put something up. So they didn't really think about that, and they try to place several trades, and all of a sudden their whole account is now tied up. They said, you don't have any more funds. What do you mean you don't have any more funds? Because it's all tied up in margin. So you got to keep that in mind with margin. That's why you can't just go crazy with the number of contracts. You got to think about the margin, because one thing you don't want to do is wake up one morning and have a margin call. And first time that happened to myself and Becky was like, what? This was in 2008 when volatility was crazy. We were trading Russell um, futures, and overnight, the margin on the Russell futures went from it was $4,500 margin to $9,000 margin per contract the next morning. It literally the margin doubled overnight because of volatility without notice. So all of a sudden, margin call, open positions. It's like, wait a second, we don't have enough money to keep the positions open, and so it just screwed us all up. So always think about don't over leverage your account. Have enough room for margin. We don't know what margin is. We can talk about that a little bit later on, but it's a percentage of the actual value. So the micros are worth about $10,000. If you could just go buy, like, let's say one share would cost you $10,000, but with the futures, you only have to put up 1/50th of that. So even though it's $10,000 is what it's worth, you only have to put up maybe $200, 1/50th the actual value. That's the benefit of futures. You're only putting up 1/50th of the actual value. So if you know what you're doing, the leverage of futures, that 50-to-1 leverage is awesome. That's why I just love it. I love trading futures because I know what I'm doing. And that 50-to-1 leverage helps me a lot because I get the benefit of having the $10,000 in my account, but I only have to put up $200 to get the $10,000 worth of benefit from that micro contract. And the full size is just 10 times bigger. All right. So this is kind of why we trade futures, and this is what we've gotten really good at, and we got away from it, I said, because the margin went high, but then came to micro, so now we're back, and this is our thing. This is our primary moneymaker, is the futures. All right. In the handout is an example of a trade strategy. We've gone over this one in the last couple of meetups where we went over futures. I'm not going to go over this one today. I'm going to go over something else because it's by request. But if you want to see this one, on the link in the handouts, on the link excuse me, in the chat window, I'll put that link in there again. Um, go to the YouTube channel and any of the last couple of meetups on futures. This strategy, we did review this strategy. So it'll give you a good example of how this works and how we actually make money on the currency futures. We trade a grouping of strategies, both long and short. No one strategy is good for everything. So we have one strategy that will get you long down here, another strategy that will get you long once the trend has been established, and another strategy that gets you short at the top of the trend, and another strategy that gets you short once the downtrend has been established. So we have different strategies to get you into different points in price movement. That's why we have, I think it's between 10 and 15 strategies total. They're really simple, but no one strategy does everything. That's why we always have trades available to us at different points in time. Okay, so if you have any questions along the way, feel free to unmute and ask the questions. If you raise your hand, I might not see it on the Zoom application. So just feel free to, like I said, just unmute, ask a question, or type it in the chat window, and I'll see it in the chat window, and I will address it. All right, so what I'm going to do now is actually go to a live chart, because what I was asked the last couple of meetups, we focus on the currency futures. The currency futures are the best, period, the best to trade. And then, but I haven't talked much about index futures. Index futures are also good, but our bread and butter is still currencies. But I'm going to go over one of the index future strategies, and then I'm going to take a look. Actually, there's always a question about profit and loss. We're going to go over that also, how to actually make money and how much money to actually expect to make and lose. Well, let's take a look at this strategy real quick. I'm going to change the share. And okay, you should be seeing the ES right now, the S&P. And on the screen, what you see on the screen, this blue line is a 40-period simple moving average. People have asked me why I have a 40-period moving average. One of the people I'd learned from in the past is Oliver Velez, and he had a 40-period moving average on all his charts, and he talked about that, and we started putting it on our charts, and it says become a staple on all of our charts, whether it's monthly, daily, weekly, or intraday. There's a 40-period moving average. It's a determination of trend and a line in the sand. So you'll see a 40-period moving average on just about all of our charts, and it gets used in some way, or shape, or form. In this case, this is a trend trade. We look for the 40-period moving average to be increasing from the previous day. That's it for determining trend. It's increasing. That's it. Okay. From the previous day. These two lines are crossing pink and green, pink and green. This is a linear regression line, and this is a moving average of the linear regression line. So here's the moving average on top. The moving average crosses below the linear regression line, plot 1. And then the moving average crosses above the regression line. Moving average crosses above. So this is plot 1, plot 2. Some of you who have seen these charts before are familiar with the T lines, right? So what we're looking for is a bullish crossover of the lines, of the two lines. You're going to also see the trigger lines in many of our charts, many of the charts. And this is stuff we give you ready to use for Thinkorswim, or ready to use. This is NinjaTrader application. NinjaTrader is free to use. We do offer futures analysis on NinjaTrader. It's also free. And you can trade wherever you want to trade, but the analysis is on NinjaTrader unless you can set up the same strategies and charts somewhere else. But we do our analysis on NinjaTrader, which is free to use. All we use this for is for the charts and nothing else. And it's free. Simple strategy. Bullish crosses the trigger lines. Plot 1 crosses above plot 2. Okay. So now, and confirmation, this 40-period moving average is increasing, and this is the Bollinger Band here, upper Bollinger Band. We just need to close below the Bollinger Band. We don't want it overextended, ready for a pullback. Simple strategy, 87 to 89% winning trades when traded per plan. We don't just randomly, arbitrarily make up price objectives and targets. Everything we do is statistical. It's by the numbers. There's a gentleman that we learned that showed us how to determine price targets and the associated probability. And we learned how to do that, and we've used it forever. It just works for us, okay? So let's take a look at this example here. This is the S&P, the mini S&P, the ES contract. Take a look at the data box over here. The ATR is 82.68. Average true range, 5-period ATR, meaning on average every 5 days, the S&P is moving 82 points on average every 5 days. Okay? That represents the volatility of the S&P futures. Okay, that is how we determine the volatility. It's moving 82 points every 5 days on average. Okay? The strategy gives us direction. We know that whenever we see this bullish crossover with the 40 increasing, and we get a close below this Bollinger Band, every single time that happens, we have an 87% probability of having a profitable trade if we follow the rules associated with that particular strategy. It's our rules that myself and Becky developed. Some of you already trade these strategies, you know what they are and you know they work, but you got to follow the rules, and you follow the rules, it works out for you. You make up your own stuff, That's okay if you make up your own stuff, but do thorough back testing first to make sure what you're making up actually works and it will give you what you expect. Okay. So with a calculator again, this first profit target is going to be 60% of the ATR. So if it ATR is 82.68, what's 60% of 82.68? Anyone with a calculator? 82, please type it in. 60% of 60% of 82.68. 60% of 82.68. 60% of 82.68. And that's 49.42, okay? All right. So for these index futures, in our trading plan, you're going to have stats for different size targets and different size stop losses. When you combine the different size target with different size stop losses, you're going to have different percentage wins and different amounts of profit to loss. So the one I'm showing right now gives you 87 to 89% winning trades. Okay. So here's how this works now. I look for this day to day. I'm looking for a cross of those two lines. This day, the lines didn't cross. Took me what, a half a second to determine that. So when I'm doing my daily review, I just click on ES. Nope, lines didn't cross. Next one. Click on NQ. Nope, lines didn't cross. Click next one. Click. Goes really, really fast. I'm just looking for two lines crossing. Very visual. There's a lot that goes into it to develop this, but the final version is a setup, trigger, and trade management. The setup is visually what you're looking for. Nope, 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 no cross. Nope, next, no cross. Nope, then cross. Nope, then cross. Hey, wait a second, did it look like a cross? So I'll take a look at the numbers, I'll look at the data box, it's too close to tell with my eyes. And if you take a look at plot one and plot two, the plot one crossed above plot two that day, then plot one number the greater than plot two on the data box. So I got my crossover. Okay. So that's my trade signal day. That's when I know I have a valid trade that day. I look at my trading plan. I see whenever this happens and my 40 is increasing from the previous day and it closed below the Bollinger Band, I now know I have an 87% chance I will have a winning trade if I take this trade. Okay. And these stats go back to 2003. So it's 22 years worth of data is where this comes from. Every single trade, the valid trade that's happened over the last 22 years or 23 years comprises that. So that 87% to 89% wins is based on every single valid trade since 2003. That's where the 87 to 89% wins comes from. Looking at every single valid trade of this strategy. So what we do, we're going to buy at the next open. The next open is the next day the market opened at 6032.25. What's 6032.25 plus 49 point, let's make it 40 plus 49. What's 60? So the open is 6032.25. So 6032.25, look at the data box. 6032.25 and add 49 to it. What's that number? 6032.25 and add 49 to it. Someone type it in. Open 6032.25 and add 49. What's that number? Okay, so that would be our first profit target, 6081 in the data box, in the chat window. Thank you, Olga. On this day, the market went as high as 60.93, so our first profit target was hit. If you want profit beyond the first target, then you have to do more work and trail stops. How this would work, we get our trade signal this day. We look at our trading plan. We have 87% wins. At the next day's open or lower, we put in one order. We put in our entry, target, and stop loss all in one order. So as long as you're at or below the open price, you can get in at market value, enter at market at or below the open price. And once that order is filled, it then triggers a one cancels other bracket order with a target and a stop loss, which is down here. And the stop loss is also based on the ATR. So, and that's it. That takes just a couple of minutes, basically, to do your analysis, place your order, and walk away. There's nothing else to do. There's no looking at intraday charts. There's no sitting there for hours. This is all end of day. This is an end of day chart. The market closes at 2 p.m. Pacific time, opens at 3 p.m. Pacific time. So after 3 p.m., we place this trade and walk away. Okay. For the amount of profit, it's the E-mini S&P, the micro version is $5 a point for the micro. It's $50 a point for the full size E-mini. So for the micro, what's 49 times 5? What's 49 times 5? That's the amount of profit for one micro contract. What's 49 times 5? Type it in. 49 times 5. $245. Thank you, Olga. So you place this trade for every one contract you traded, one micro contract. That's $245 of profit when it hit the first target of 1681. Okay. If you were trading a full size E-mini, that would be $2,450 when it reached the first target of 6081, right about here. Okay. Not everyone can afford to trade the full size. Number one, you need a lot more margin, and number two, your stop loss will also be a couple $1,000s. So you have to determine that based on your account size, what you can trade and how much you can trade, how many contracts you can trade. All right. So that's the basic strategy. Now, I had a couple of questions. Could you please speak about after the first, speak about what you do trailing after the first target. Okay. So let's say on this first day, sometime during this day, this could have happened at 8 p.m., 9 p.m., 2 a.m., 6 a.m., 12:30 p.m. the next day. The target's hit. At that point in time, you get an alert that your first target's been hit. You get either a text or email. Now, assuming you are trading more than one contract, you would sell if you are intentionally looking to trail stops, then you have two sets of orders. The first set of order gets you out a certain percentage of your position at that first target. That's done. Target's hit, you're out of that first part of the position. The second part of the position will have a much bigger target, whatever that bigger target is, but a bigger target and the same initial stop loss. After the first target is hit, you then have to manually change your stop loss value to something above the entry price. If the entry is the open price, then your stop loss has to move up to above the entry. The tighter you can put your stop loss right here, your target's here, 60.81, you can put your stop loss at 60.70 something, but there's a good chance it'll be stopped out quickly just with the natural retracements and going on in the market. So the looser you make your stop, you can put your stop loss further down, but then you got to be willing to give back more money because quite often it will go back and retrace and stop you out. So it's for people who just want to grab their 40 to 50 something percent return and they're done, great. But people who want to spend more time, effort, energy, trailing stops, that's okay too. Keep in mind the big moves happen only maybe 30 to 40 something percent of the time. The other 50 to 60% of the time, you're going to retrace and stop you out on that last part of the position. So you have to do the math. Is it worth your time and effort um, for the profits you will make from the trades you will catch the bigger moves in versus the number of trades where you're going to be giving back money on the last part of your position? Because if you don't get something for nothing. You want to make more money, you have to be willing to give some back, and you're going to give money back on probably 60% of your trades. So, and also you have to have the time desire to manage because you might have multiple trades on the same position. You might, excuse me, on the same symbol. Are you someone who can keep track of all of that? Do you have the time desire to track? You might have 4 or 5 trades on the same symbol in your trading platform. What's your plan to separate this trade from that trade? Um, and you have part one of this trade compared to part two of this trade compared to part two of the other trade, all the same symbol. You got to keep that in mind. It's easy to just put in first target, entry target, first target, and stop loss, and you're done. So it's all up to you. Everyone starts out all in, all out, and then some people try to um, do more trailing stops. And if it works for you, great. If it doesn't work for you, great. It all depends on how much time you have to actually put into it. Let's see, another question. Is strategy based on trigger line or NinjaTrader crossing? And is it based on trigger line and NinjaTrader crossing? The strategy is number one, a trend trade. So we look for the 40 increasing. The setup is the trigger line crossing. And we have multiple trigger line related strategies with different values for the trigger lines. There's some default setting that can vary from 80 and 20 to 20 and 8. And so different strategies we use have different settings for the trigger lines. There's no one setting for everything. So different settings for different strategies. But yes, the strategy is based on the trigger lines crossing. That is the first thing we look for the setup. And then we look for other things for the confirmation with the 40 and the Bollinger Bands. But yes, what we look for is this crossing. It happens over and over again. It's a great trend trade. This one's not valid because it closed above the Bollinger Band on the day it crossed. And that usually leads to a pullback. So we don't deal with the ones that close above the Bollinger Band. Here we go. It crossed 40 increasing, closed below the Bollinger Band. Good trade. Here 40 is, let's see, the 40, you can't tell if the 40 is increasing or not just by looking at it. So this day the 40 is 5520.04 and 0.24. The 40 is increasing. Good trade. Buy at the open. Beautiful trade. Buy at the open. Beautiful trade. Buy at the open. Beautiful trade. Okay. It's a great trend trade for the indices. And you usually, why some people, well, actually just about everyone likes doing this more than options is because you get your money really fast. That's the benefit of having a 50 to 1 leverage. We're not looking for a big move. We're looking for a small move with 50 to 1 leverage. So you get big returns for very small movements. The 60% of the ATR is really not that big a move, but it gives a very nice percent return. That's the thing. It works for us. So that is why we do it. That's why we trade futures. That leverage is great. Got to be very exact and businesslike in your approach. Nikki, why did you take 60% off ATR? We tried all sorts of values. Um, okay, it's the 60%, it goes back to myself and Becky. We accept nothing less than 80 something percent winning trades. Part of it is just financial, part of it is psychological. People say, "Oh, I want to trade this strategy, but it's not been working for. I'm not sure why, because you're taking too many losses. You literally messes with your head. You can make money if you have a strategy that's only a win 50% of the time, or even 40% of the time. You can make money doing that. It's not a big deal. But psychologically, can you accept being a loser 50 to 60% of the time and giving back big chunks of money? Because you could be up 80, 90% on a trade and give it all back because, according to your strategy, you don't lock in profit until you get this much bigger return. Okay. And so the 60% came from trial and error, seeing what works for us. And also, if it goes back to the gentleman, his name is Daniel Gramser. He's the one that explained how to determine the stop loss and targets. And it took many, 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 many hours of work. I saw him a couple of years ago in E-Trade convention here in the Bay Area, and I told him myself and Becky had done what he said, and he was surprised because he said no one ever does that because there's so much work. But I told him, and we had done it and it's been working for us. But it's trial and error. How big does your stop loss have to be to achieve a certain amount of profit? And what size profit is achievable with a certain size stop loss before the stop is hit? So if I want, let's say I want an 81 times the ATR target, that sounds great, but it might only get there 60% of the time before my stop loss is reached. The bigger your target, the less likely it will get there before the stop loss is reached. So it's a balancing point between the target size and the stop loss size. So generally speaking, our stop loss is big enough to achieve the 60% ATR target 80 something to 90% of the time. And so that's how that's 60% of ATR. And we have strategies where it's 70% of the ATR. And for the currencies, we have the target could produce anywhere from 30% return to 60% return. So this particular example will give you a 41 or 42% return at the first target realistically, given the size of the stop loss in this particular example. Other index futures will give you a 50% return, okay, at the first target. If you want more, it goes back to trailing stops and that type of thing. Okay, I recently used your trading strategy on option contracts and backtest your strategy on multiple stocks. And cool. If you want, we can talk for a little bit. I'm not sure if we've ever chatted before, but um, our option stuff we've been doing forever. It hasn't changed much in years and years and years. So we know the options work. And the futures, we have certain strategies we've developed. And people have been asking me about trade signals. So I don't believe in just doing trade signals, but I decided to set this up on our future strategies on Collective. Collective is the site where I can trade all these strategies and people can follow it. You can subscribe to it. I just set it up a few weeks ago. So all of our valid trade signals will be posted there. So for people who want to follow that, I'll probably in another 2 months make that publicly available. if you want to look for it, but I'll make it public. I want to get a couple months of valid trades being tracked. And collective is where a third party independently tracks the trades, and you can subscribe to those trade signals through collective, but they independently track the trades. So it's the same signals we send out. I send out each day on email for those of you who get it, but I'm putting it on collective for people who want it there. So how do you know if ES is presently in a potential reversal? For Olga, I don't know and I don't care. I just wait for the trade signal. I don't try to look for anything that doesn't exist. So um, I don't look for anything that's not part of a strategy. If something, so Olga, if something isn't a valid trade signal, it doesn't exist to me. I don't even think about it, don't consider it in any way, shape, or form. Not even, I don't even think about it. I just look for the trades when it's valid. That's all I look for. I don't think about reversals and stuff like that. I That was back in the day when I'm like looking for, nah, I just trade signals because you know what the stats are. When it's time to go short, we look for the trade signals. And for Olga, the best S&P short signals are actually on, you have the option stats. The options, if you were trading the options on the S&P, then you should have seen all those trade signals. So that S&P option strategies are the best for the shorts on the S&P. They all hit in the last couple of weeks. They hit big time. So you got lots of sell signals on multiple things in the last couple of weeks on the S&P. So between the options and futures, you can really, that's why it's good to trade both. So there's certain times I trade options, certain times I trade futures, and sometimes I trade both. That's why I love both. There's a time and place for each one, right? And James 40, okay, so can it James? Okay, let's see, questions. Let's see, the strategy based on, okay. All right, so let's take a look at, because the big thing is people, especially newer people, how do we make money? How do I know your strategy is working? After a couple of losses, why should I trust it? That's where you have to understand the big picture. So the big picture, I think, is one of the most important things, understanding the big picture. I wish people had shared this type of knowledge with us when we started trading, myself and Becky. But then we found out the people who were teaching us didn't actually trade the strategies. They were hired to teach a class. It wasn't until we surrounded ourselves with people that actually trade their own money is when we really evolved. And that happened when we went to the Traders Expo in Las Vegas and we started meeting people, the people who wrote all those books and the people who do certain presentations, they're there in Vegas. And when we talk to them, you quickly find out real fast which one of them really actually trade. Some of them don't trade. They don't, no, they don't actually risk their own money. They're just hired to do a presentation. So, and what I would do is I would actually talk to the presenter after they've done their whole presentation, catch them in the hallway or even, yeah, the hallway just afterwards and ask them straight up, tell me what you actually trade versus what you did in your presentation. And they'll be totally honest to you. They tell me almost every single time they do not trade what they've done in their presentation. They actually have a personal stock portfolio and trade covered calls. That's all they do. Or, and one person told me he tells exactly what he tells everyone to not do. He just sells naked call options. And because he has the skills, even if gone horribly wrong, he knows how to fix it. But he does in real life with his own money, different things than what they present. So, but the people who trade their own real money are the ones who really taught us how to manage capital, manage real money, risk sizing. No one had taught us about all the, we spend about $30,000 on education And not one single one of them told us about what percentage of account to risk. Not one single time. It wasn't until we were learning from John Carter and Hubert Centers, trademarkets.com. When they talk about is when they went over account sizing because they were trading real money. And for day trading, John even said he had his broker set his account so that if his account was drawn, if his whole day trading account was drawn down by 2% for the day, to shut him down. Not 2% on a trade, 2% account for the day, to shut him down automatically because there's something wrong. The strategies are not working. There's something going on in the market that day that's throwing the technicals off. Something's not working, shut it down. And I took that to heart. It's like, that's why you have to have your risk management set just right so that you don't take big losses. We don't take big losses. And the losses we do take, we recover from quickly. So anything you see in a rectangle is put there by Becky. Becky is a database manager. This is what she does. She tracks numbers, stats, all this type of stuff is what she does for a living. She's the one who does all the numbers and calculates everything and keeps track of all this stuff. I don't do this. I'm the guy who literally, when I'm getting ready for trade, these are all my futures trade the last couple of weeks. I just write them on a sheet of paper, all the information, and just lay them there. It takes me a couple of minutes or two. That's it. I don't do all this typing thing. I do this really, really fast. So we work together really well. I like to do this stuff, and she is behind the scenes, taking care of the stuff behind the scenes. So between the two of us, we get a lot done, and she does all the stuff I don't like, and I do all the stuff she doesn't want to do. So it works out really well. All right, so I asked her to put together all the trades since 2019 as an example so people can reference it and see what to expect in real life if they're trading it. This is based on trading the index futures and the currency futures, all of them, with our current set of strategies. And risking the 25 grand account is based on 25 grand account and risking 1% of account per trade. This could be any size account. This could be a 10 grand account. This could be a $250,000 account. This could be $1 million account. This could be an $80,000 account. Okay, it doesn't matter. Percent return is percent return. But we're risking 4% account, which is the high-end max, no more than 4% because margin will screw you up. So 25 grand account, $1,000 risk. In real life, it will never be exactly 1,000. It might be 900 and something. It might be 1,100, but it'll be, if you're going to risk $1,000, it'll be around 1,000. If you're going to risk $500 a trade, it'll be around 500. Not exact. Percent return stays the same. All right. So let's say you started out in January 2019. It's gonna suck for you. You started out, you heard about this great presentation, you heard about all this great how profitable this strategy was. This guy you've been listening to for a while. You signed up for the program, and this is how it started. You got loss after loss. You made a few dollars back. These are just first targets only. Worst case scenario, first targets only. But at the end of the month, you just lost money and your account's down, you're down, and you're like, well, this sucked. This is not what I signed up for. And what happens? Most people stop. They're like, this program I signed up for is no good whatsoever. It's awful. I just did nothing but lose money. Blinders. People tend to do this. They look at what's in front of their face, and that's all they do. This is all they'll do is look what's right in front of them. Guess what? You have to see the big picture. Not this, big picture. Okay? You have to keep trading and understand the big picture. This month you're down trading. Well, you keep trading. Next month, hey, you made some money back. Next month, you're profitable. Once again, these are just worst case scenario, first target wins. This could be more, this could be more, this could be more. There are choices in the plan. for bigger targets. Okay, I'll give you worst case scenario. Um, and we don't look for quantity of trades, we look for quality of trades, not quantity. You don't make a bunch of money by, this is not day trading. You wait for your valid trade setup. Once again, learn from John and Hubert. You wait patiently for your valid trade setup. You take the trade, and you know what your risk reward is. You know you have a percentage chance of profitability, and we don't trade anything less than 80%. And realistically, we average about 85 overall. Okay, 3 months in, you're profitable. Now you're really profitable. It starts going into March, April, May. Beautiful May, up 17% return just for the month of May. Okay. Certain months there'll be fewer trades in March, June, September, December. There'll be fewer trades because of rollover and quadruple witching. We don't trade much during those weeks, and we do not trade in December. December you only trade in December if your goal is to lose money. If you want to lose money, trade futures in December. If you want to make money, trade options in December. Big difference. All right, July, beautiful July. Remember, you had a really bad January. You have to keep trading, big picture. And you go through October, another great month. End of the year, 73% return on the account. On the account. Okay, 25 grand account, $18,000. If it was a $50,000 account, this would be $36,000. If it was a $100,000 account, it would be 4 times this. Okay. What I learned from John and Hubert when I started real trading futures stayed in my head. If you have a $100,000 account, you should be able to make about $50,000 a year off it with futures. With options, maybe not. It depends. That depends. But with futures, this is what I'm calling now. This is our end game. We've gotten to a point where this is what we've been working for all these years, and we're trading it now. And that'll be the name of the strategy on Collective, also at end game. So stay tuned for that. So this is with 4% account risk. This is now 2020, one of our best years ever with COVID. I had nothing to do that year after March because everything was shut down, so I was focused on my trading. January, COVID year, 4.9% the first month. February, 12% return on account. Once again, we assume a 25 grand account and $1,000 risk per trade. This is just trading what's valid. No speculating. We do not speculate. Pure business. Business, business, business. We have our trading plan. That is our business plan. We follow our business plan / trading plan. We want repeatable results. If I give this to 10 different people and have them follow those rules, they should all achieve comparable results. There's also margin for error. So if you mess up a little bit, you can still make money. So we have built-in margin for error. All right. I said this is one of our best years of trading was the COVID year when people were just getting destroyed and and early in the year, the market just got crushed in January and February, then rallied back. If we just had sell signals, we had lots of sell signals. We just kept profiting from our sell signals as the market was dropping. And then as the market turned around and went back up, we then back to regular trading, longs and shorts. Yeah. But we just follow the plan. We don't care what the news is. We don't trade news. We trade technical signals. That's it. Nothing else. And to get to where we got to, personally, I know I've put in between 25 and 30,000 hours developing the strategies and trading live, and gone through a couple $100,000 in aggravation to get to that point also, but come out the other side. But literally 25 to 30,000 hours of hours. And if you wonder how you do that, when I was at work at Lockheed, I worked 40 hours a week. Then I'd come home and spend another 60 hours a week on my trading. I was determined to get this to a point where I was profitable. I saw it was just, so if you think about that, put at least 50 hours a week, 50 times, 50 weeks a year, every year. And I just kept at it to this, even right now, I'm not satisfied. I spend at least 1, 2 hours every day. How do I improve our strategies? That's a constant ongoing thing with me. This for me is like a puzzle. How can I make this work better? How can I get more out of this? How can I get more profitability out of our strategies? So end of 2020, we had like 1 or 2 losing months, barely. 107% return. Also have the stats if you're doing currencies only. See if you're just doing the currencies in 2020 and not the indices, 65% return was just doing the currencies. If you have a smaller account and you can't afford the index futures, then you just trade the currencies only. So for people with smaller accounts who can't afford to trade NASDAQ, is just too big, the dollar amounts, then you just trade currencies only. Then you can risk a couple $100. Still a 65% return, right? With just the currencies. Remember, there's just a margin difference. Difference is margin. If you can't afford the margin for indices, you just trade currencies. 21, once again, you you might have a month like this where you make money, make money, make money, then the second half of the month you give it all back. This is discouraging. It kind of sucks. The last day of the month you gave back all the money you made. Ended up break even for the month basically. That's normal trading. It happens. You're going to have at least 2, maybe 3 months a year that are losses, offset by 2 to 3 months a year, which are wins. And the other 6 to 8 months a year is your profit. Big picture. Every year, expect 2 to 3 months of losing trades and expect 2 to 3 months of winning trades to offset that. The remaining 6 to 8 months is your profit for the year. That's why you have to keep trading and understand it's a business. No business makes money every single week, every single month, or sometimes every single year. You have to have the big picture. Some companies, businesses, especially retail, they only make their real money around the holidays, is when they make the big dollars. Okay. So, like any other business, not every month is profitable, but your profitable months totally negate the losing months. As long as you keep constantly pulling in capital, the numbers work out real nicely. End of 21, you had like 2 losing months in 21. 116% return. That's why when people say, I want to double my money, you don't double your money by taking more risk, by I want to let it. No, you double your money by following the plan and taking your trades per plan, and the money just sort of adds up that way. Smaller account people, this is 21. You go to the currencies, trade currencies. If you have a smaller account, can't afford the margin for the big account, for the 61%, if you're just trading currencies, and the margin's not an issue, just the currencies. If you're trading indexes and currencies, 116%, you're doubling your account size. That's what that means. You double your account size, and with 4% account risk per trade. 22. Oh, lots, two back months of losses. This is what crushes you psychologically because it makes you question everything. Because here's what people tell me. It's like, well, did the strategy stop working? No. It's just the way numbers work out. Sometimes all the losses get bunched together. And there might it's still the 2 to 3 losing months a year. So people were freaking out. It's like, I've had losses, I've had losses. What do I do? Keep trading. That's why you trade size appropriately so you never lose more than a certain percentage of your account. Because if you lose a really huge percent of your account on one trade, you can't make it back. You just can't. Um, so you keep trading. So down 9%, down 7%. Month after that, you made it all back up 19%. Just like that, boom, in 1 month. Just take your trades. When they're about to take the trades, take the trades, take the trades. You make your money back. That's why you have to have the big picture business point of view and from a business-like point of approach, so that it's less emotional when you understand the big picture and know you just have to trade size appropriately. Don't risk 10, 15, 20% of your account on one trade, because at some point in time you will have multiple losses back to back to back to back. It will happen. And you don't want to wipe out 40, 50% of your account because you got carried away with trade sizing, okay? And how much you're risking. So the 2 to 4% account risk is as big as you want to go. We had three losing months that year in 22. With 3 losing months at the end of the year, what do we have? What do we have? A 65% return. Give me a 66% return with 3 losing months. That's with consistency. Once again, the business-like approach. Losses happen, but you have to understand the big picture when losses happen. You just keep trading. And this is an example of every time myself and Becky have ever had a big loss, we look back and well, if we just followed our plan, everything would have been fine. And as we evolve, we just followed our plan. Get a loss, follow the plan, this next trade, next trade, next trade, and the numbers work themselves out. And most of these trades take anywhere from a few hours to about a week, realistically. So between a few hours and a week. So you get your money back really fast. 23, 1 or 2 losing months, 70% return. And for those of you who trade options, you know you don't get these type of returns on options. You don't have the 50 to 1 leverage and the exactness. You get a good positive return on your account, but not 70, 80, 90% returns on option strategies. This is 24, 58% return, and where we are right now in 25. Beautiful January. We had a couple losses in February, and here we are right now. So this is where we are right now, up about 12% for the year. But anyway, this is how we trade in a business-like way that took us from losing money, being inconsistent. We make money, lose money, make money, lose money. But once we figured out how to develop our stop losses and our targets, and it just became in our trading plan, we have several different stop losses. So people I'm working with had asked me, well, what if the stop loss was this, or what if the stop loss was that? So we put those different stop losses in so people can choose. The smaller the stop loss, the bigger, higher probability it'll get there naturally. Uh, and you'll get more winning trades. So we have anywhere from a 30-something% return at the first target up to about a 60-something% return at the first target, depending on your choice of targets and stop losses. So that's is shown in the trading plan, and what you see on here are the worst case scenarios. This would be a 50% return at the first target. This would also be a 50%, this would be a 29% or 30% return at the first target. But there are other choices that you can take if you want to that can give you a bigger target. We just took the most conservative one, and that's it, the most conservative. So we always do conservative when we show this. But if you follow this plan, this is pretty darn close to reality, okay? You'll never be exactly 1,000. You won't be in every single trade. That doesn't happen. You cannot be in every single trade. But as long as you do a pretty decent job of catching most trades, then like I said, a 30 to 60% annual return on account is pretty normal and expected. Normal and expected, and with the futures, as long as you follow the rules. And I work with people one-on-one. I got a couple of new people I started with a couple about in the last 4 to 8 weeks, and we've really just got them trading live ASAP. Because even with the currency futures, even if you risk it $100, it's better to learn risking $100 than just doing paper trading. You learn with real money, and with the currency, you don't have to risk much, and you learn a lot faster and quicker with real capital. All right. Do you have any questions at all on any of this stuff? I'm going to switch back to the presentation.
I have a quick question.
Okay, Nikki.
Yeah, so I know you use a linear regression line, and I know Thinkorswim is what I use, and they have one. Are you
Yes,
using that same one as a seven for the linear regression?
20 on, hang on a second. Yeah, I'm going to change the share. Hmm. This particular one is a 20 period linear regression line. They do not have the moving average, but they do have the linear regression line. So on Thinkorswim, you have to program the moving average yourself. Or for people I'm coaching, I will give you this for Thinkorswim.
So you have to program it yourself. Okay.
Yeah, the moving average, the linear regression line is already there, but the moving average is not. The moving average, you have to program yourself. Someone had helped me out with that and given me and done it for me. So for people who I am working with, I will give you this for Thinkorswim. I'll give you all of this for NinjaTrader so you can get this. You don't have to do any of this stuff yourself on NinjaTrader. Just hand it to you. It's already shareable. Just load the software on and I go through the charts with you and everything is done, ready to go in a couple of minutes. The first time I spend a session with people is to get the computer set up and the software, and then you see what I see. People don't always realize it, but when you look at a chart, even though we're looking at a chart of the same symbol, the numbers you see and I see might be two different things because you might be having your chart, whether intentionally or unintentionally, set to look at the bid price. Someone else is set to look at the ask price. Someone look at set the mean price. And exact same chart, but we're looking at three different values depending on what defaults are on your platform. So I like to everyone to have see the same thing I'm seeing. And so I share the exact charts with the exact setup with the exact everything. And if you have Thinkorswim, I'll give you all the stuff for Thinkorswim also. But we do the analysis on NinjaTrader. You can trade wherever you want to trade for the live account. All right. So always have a goal to end in under an hour, but that never happens. So let me change the share. For those of you who used to come to the live meetups, we'd go like hours, right? For like 3, 4 hours. We do a 3 hour session and then live, and then after that, people stay another hour. All right, so like I said, this is one of the examples of one of the strategies, one of them. And what we did, I used Australian dollar, Canadian dollar as an example for all the valid trades from 2003 through 2024. Um, Win percentage, loss percentage. But it's how we trade. We just literally go through every day and look for what's valid. It's a pretty quick routine once you have a routine down. It always seems overwhelming because I say we have 13 strategies and so many charts, but once you get a plan on how to approach it, it's like, oh, that's not a big deal. Not a big deal at all. It's like for me, it takes me about 5 minutes to review all the strategies to see what's valid. You don't have to spend time on stuff. If something looks valid, then you spend time on it. Otherwise, it's like this visual. Did the two lines cross? Nope. The two lines cross? Nope. Next. And you go through it really fast. So you got this as an example. Let's say if you look at go to the YouTube channel, look at any of the past couple of meetups, then you're going to see a much more detailed review of this strategy. It's a short strategy, and all the numbers are here. If anyone wants to work with me on this, let me know by this coming Friday. I'll give you a 250 discount on the futures program, 250 on options, or 750 if you want to do both. And right now, I do everything one-on-one, everything one-on-one. Why I do one-on-one? People have asked me, well, you can make a lot more money with people if you just do a big group and that type of thing. And well, I've done big groups and I didn't find them as useful to me. Um, not meaning when I've taken courses as part of big groups, and you don't know what people really need help with unless you talk to them specifically, get them to ask questions. Um, when I work with people one-on-one, if someone I've been there's someone like as an example, someone I've been working with for a while now on futures, and I kept wondering why they only contact me at certain times, and I'm like, why? Then I said, yeah, they didn't realize futures markets were open 23 hours a day. They thought the futures market was the same as the stock market. And I'm like, really? Um, no. So they're trying to find all their trade signals at the wrong time, and they're planning all their hours at the wrong time because they didn't realize futures was different than the stock market, and it's very much different. And hours are different. It's a 23-hour a day market. Stock market's only open 6.5 hours a day. So things like that is where I like to work with people one-on-one because I found that I might have to explain the same thing three different ways for someone to understand it. Not everyone's the same. There are things I think are really complicated that people get like that, and there are things that I think are really simple that people just, I don't understand. You're speaking a different language. I'm like, so I have to find different ways to communicate the same information so that I make sure the person I'm working with understands it. Um, because you want to eventually be able to do this stuff on your own, and you can't do it on your own if you have concepts incorrect. And also need people to be comfortable telling me when they messed up. When I don't hear from people for a while, it's usually because they did something wrong or too embarrassed to tell me about it. So I'm like, hey, I haven't heard from you for a while. What's going on? Give me a call. And then I talk to them. It's like, oh, we messed up. We were doing. Yeah, I know that. That's what happened. That's why the one-on-one thing is really important to um, make people comfortable working on these strategies and doing it, get to a point where they're doing it on your own. There's one person I'm working with who's on the other side of the planet right now, 12-hour time difference. And I work with him one-on-one for every futures trade. He could do it himself if he wanted to, but he really more comfortable working with me one-on-one. So I'm literally holding his hand and going through every futures trade placement. And it might take 2 or 3 minutes, but I'm there with him each time because that's what he needs. That particular client needs this, and that's what I do. And eventually he'll be comfortable on his own doing it, and that's fine. But in the meantime, that's what he needs. So one-on-one. Got a question from Olga. How do you know if he has okay, the same reversal. All right. So if you're interested, let me know before the week is over. This is the regular price here, and then we apply the discounts of these amounts. And I don't put a time limit on how long I'm going to work with you. I put here at least 6 months of support to get your trading consistent. There's no real time limit. There's no real time limit. People have been, I always say the name Steve. Steve was my first coaching client. That was probably back in 2008. He still, to this date, emails me every single weekend. He's traded everything with me from stocks, futures, commodities, Forex, options, every single thing. He now settled in because he retired. So now he only does the weekly chart option strategies and nothing else and buys shares. So he learned shares from me also on covered calls. He refuses to learn from anyone else, just me. That's it. But he still emails me every single weekend to verify his trades are valid. Um, because you always want to have a second set of eyes looking at what you do. We have our Facebook group also where people can go to ask questions and share with others. But it's good to have a second set of eyes. I have people still email me. I email out the trades every day, which I find. And for people who are doing it, they're reviewing their own, they compare what they found to what we found. Okay, so I do that for 1 full year. From when you start, I will email you the trades every single day for 1 year, so till you get to a point where you can do it on your own, so you can become confident. And I will work with you, whatever your time schedule is. We set it up. I don't have fixed office hours. Need to meet at 8 in the morning, I'll meet 8 in the morning. Need to meet at 10 at night, I'll meet you at 10 at night. So we just set that up based upon mutual availability. I'm pretty flexible on schedule. So, all righty. So our next meetup has probably been about 2 to 3 weeks. It'll be option related, and it will be about grouping from sectors. If you want to trade an energy sector, if you want to trade metals, if you want to trade just indices, what do those win-loss stats look like? You just group those type of sectors as one. So if you want to trade oil or energy, then you might be trading the XOP, USO, UNG, natural gas, XLE, the energy ETF, that type of thing. And if you group all those ETFs together for energy, what does that profit and loss look like? That's what we'll probably do in a couple of weeks. So stay tuned for that. Let me know about the coaching and if you want to work with me on futures and or options. Pricing is here and discounts are here. And otherwise, if you don't have any questions, we'll just end the meetup now and then start again in a couple of weeks, or email me anytime, call me anytime. You got my phone number, you got my email, um, contact page on our website. If you haven't been there yet, go there real quick. Hang on a second. I put the link for the handouts is right here on this page. So all the handouts are here. Okay. Coaching programs are here, same programs that's in your handout. Same program, and you have what the discounts are. On the home page, a little bit about me, and I was invited to do a podcast a little while ago. I wasn't sure if it was going to be an ambush podcast or what they were going to do, but I just showed up, and it was a good podcast. They asked me a lot of questions, and I was just pretty straight up. Whatever they asked me, I answered honestly, straightforward. It was really good podcast. So a little bit about me there and my approach to trading and my personality and stuff like that. And someone a while ago had asked me, they only wanted to trade the Qs and nothing else. And I was like, why do you only want to trade the Qs? You're missing out on all these trades. This was NASDAQ. And so I did this thing where I put every NASDAQ trade on one chart for 1 year. This was in 2020. And that's all they wanted to do was trade NASDAQ and nothing else. That's all they wanted to do. So this is what it looks like. 90 something percent wins. It was 41 trades and 3 losses. This is what it looks like when we map it all out. So it's good to do this once in a while just for the visual. I got a question for Olga. What do you consider opening for futures? It's futures opens at 3 p.m. Eastern time each day. So futures open at 3 p.m. Eastern and they close at 5 p.m. Eastern time each day. Question from Olga. All right. So the stock market is the 9:30 Eastern deal, but the futures market is 6 p.m. Eastern time for the open. So always make sure you know that. I've had a couple of people who didn't realize that, and some people didn't realize the stock market actually opens at 8 a.m. Eastern time because they didn't know about this thing called pre-market. In pre-market, you can start trading, just not options, but you can trade shares and stuff in pre-market. They didn't realize that. So um,
Sorry, did you say the future start at 6 p.m.?
6 p.m. Eastern is when futures start trading.
But
So
you
this
said futures was 24 hours, correct?
23 hours. So it will open at 3 p.m. this afternoon, Pacific time, and it will close at 2 p.m. tomorrow afternoon for 1 hour. So 23-hour market. That's why we don't see a lot of gaps in futures during the week. You might see a gap a couple times a year on a weekend if there's some big news event happening, but we don't see many gaps in futures because it's only closed for 1 hour on the weekday afternoons. All right. So far to keep. All right. So I'm going to go ahead and bring this to an end unless there are any questions. Like I said, email me, call me. You want to chat, you got my phone number on the handouts and on the website. I got the contact form here. Feel free to give me a call, real call. If you don't get me, leave a voicemail, actual old school, so I can call you back and leave your phone number. I always get these voicemails say, "Hey, call me back at the number I just called you from." I have no idea what number you just called me from. please leave your actual phone number if you call me and leave a voicemail. And let's see, and approaching programs are all here. So, all right. So if you, I'll be in, send out a copy of this recording in a couple hours, and I'll be setting up the next meetup very, very soon, probably in 2 to 3 weeks on a Sunday afternoon, the same time. And that'll be an options, what we just talked about a little while ago, how I'm going to set that one up, topic. All right. Then, if nothing else, see you all in a couple of weeks.